The AI Circularity Trap. Is the AI boom more fragile than it looks? What if the biggest threat to the AI boom isn't that artificial intelligence fails, but that the economics behind the AI revolution stop adding up? Billions of dollars are pouring into GPUs, data centers, energy infrastructure, and AI startups. The market sees this as proof that the AI revolution is unstoppable. But there is a deeper question investors should be asking. How much of this growth is coming from genuine end-user demand, and how much money is simply circulating inside the same AI ecosystem? This is what we can call the AI circularity trap. Here's how the cycle works. Major technology companies and hyperscalers are spending enormous amounts on AI infrastructure. They purchase chips, networking equipment, memory, and data center capacity, creating extraordinary revenue for companies across the semiconductor and technology supply chain. At the same time, capital from technology companies, private investors, and financial institutions is increasingly flowing back into AI infrastructure providers and AI companies. This doesn't mean AI revenue is fake. The demand for AI is very real. The concern is that the ecosystem is becoming increasingly dependent on continuous capital spending. And when an industry relies on ever-increasing investment, even a modest slowdown can create an outsized reaction across the market. Now, imagine one major hyperscaler announces that it isn't actually cutting AI spending, it is simply becoming more efficient. That sounds positive, but Wall Street could interpret it very differently. AI capital expenditure may be approaching a peak, and that could trigger a domino effect. Slower data center construction could mean fewer GPUs. Fewer GPUs could mean weaker demand for chips, memory, and networking equipment. Semiconductor stocks could come under pressure, and investors could begin questioning whether the enormous AI infrastructure build-out will generate sufficient returns. That is why companies such as Taiwan Semiconductor and SK Hynix are important indicators. The market may not be watching AI revenue closely enough. It may need to watch the rate of AI capital expenditure growth. But there is another threat that could make this equation even more complicated: China. Chinese AI companies are aggressively competing on performance, efficiency, and price, with models such as Kimi K3 adding to the competitive pressure. If increasingly capable AI models can be developed and operated at significantly lower costs, American AI companies could face a difficult contradiction. They are investing enormous sums to build increasingly powerful infrastructure, while competition could simultaneously force them to make AI services cheaper. Think about the paradox. Better models, lower computing costs, and cheaper AI services could be fantastic for consumers, but potentially challenging for companies trying to earn returns on massive infrastructure investments. And then comes the question of where institutional money goes if investors become nervous. Gold and mining equities could attract more attention as traditional defensive assets, particularly if concerns about economic growth, debt, and asset valuations increase. Bitcoin is different. While Bitcoin can perform exceptionally well in periods of strong liquidity and risk appetite, it has often behaved more like a risk-sensitive asset during periods of market stress. So the important question is not simply whether Bitcoin or gold will rise. It is where institutional investors choose to seek protection when uncertainty increases. So, there are 3 signals I would watch very closely. First, does a major hyperscaler begin moderating its AI spending guidance under the language of efficiency or capital discipline? Second, does a low-cost AI model trigger a sharp repricing of American AI-exposed stocks by challenging their pricing power or infrastructure assumptions? And third, does institutional capital continue rotating toward gold and mining equities while Bitcoin behaves more like a risk asset? None of these outcomes is guaranteed. The AI revolution could continue expanding for years. But there is an important distinction investors cannot ignore. Revolutionary technology does not automatically make every investment in that technology a good investment. The biggest question isn't whether AI will change the world. It probably will. The real question is whether the profits generated by AI will be large enough to justify the extraordinary amount of capital being committed to building the AI economy today. Because if the money flowing through the AI ecosystem begins moving in reverse, what looked like an unstoppable flywheel could suddenly become a circular trap. And when a financial cycle breaks, the market doesn't wait for the headlines. It moves first. If you want sharp analysis on AI, global markets, technology, and geopolitics, subscribe now because the next major market shift may already be taking shape beneath the surface. If you found this video helpful, please subscribe, like, and share the channel. Every click is not just encouragement. It's the fuel that keeps us going, creating, and improving. Your engagement is our biggest motivation. Thank you for being part of this journey.